Good morning and welcome to this Hafnia Tankers event. Welcome to you, Michael Skov, CEO. My name is Ture Østergaard. I'm with HC Andersen Capital. It's a pleasure to have a company like yours, Michael. These days, it's really a lot of money you're making in Q3. We'll discuss that in a second. I'll go through the slides, but overall we have an agenda for you. Please ask all your questions in the field, and I'll let them through. Welcome everybody. So we kind of wanted to go into the overview, of course, then into some financials, and of course the outlook and the order book is relevant. And then feel free to ask any questions you may have. But welcome, Michael.
Thank you.
And I think we can just go through basically I think let's go through the financials a bit later. But overall, you're changing one very, very key thing today, and that is your dividend policy. Could you perhaps give us a bit of insight to that?
Yes, that is correct. So basically, we have decided to change the dividend policy, obviously reflecting the fact that, not only are we in a strong market, but we also think we're in a market that will continue to be strong for a very long time. But bearing in mind that in times like this, you should also make sure that you carry with you, a proper balance sheet. We've basically decided to tie up the dividend policy to the net LTV that the company has. So what that means is that we still have a basic dividend policy of 50% of net profit annualized, but paid out quarterly. But we have now increased it so that when the net loan to value is below 40, then it goes up to 60%. And when it's below 30, it goes up to 70% and so on. So basically, the lower the leverage of the company, the higher the dividend. That is the principle.
Yeah, and just a few check questions, because I think this will, there's a lot of things in this, but what has caused you to do this? I mean, what has triggered this? Because normally you would argue that 50% is a generous dividend policy.
Yeah, so the main reason is really that, as we communicated already last year, that we have done quite a lot on the expansion side. So we basically feel that, the current business is at a place where we'd like it to be in terms of size and scale. So we don't have any upcoming capex. We don't have any massive new building programs or anything like this. So, we think that it's the right thing to do actually to pay back to loyal shareholders at the same time as making sure the balance sheet follows along. So that's really the key element. We think that at this time, the money should go back to the shareholders that's been loyal enough to support us while the market has been growing, and we've been growing the business accordingly.
And I'll take some questions in between here. What can bring net loan to value ratio lower going forward?
So, well, first and foremost, and what's already happening now is that we are at 43% as we left Q3, but we can already see now, being halfway a little bit more into Q4, that values of assets have already gone up from where they were. So that's one important parameter, is that the increase of assets, will bring the net LTV down as well. So as it looks now, I mean, with the increase we are seeing in assets, I would say it's probably highly likely that we already will be below 40 after the end of Q4. So that's obviously one of the the main reasons. The other one is, of course, the cash that we make. So basically, we define it as the value of the assets less the debt, but also less cash. So of course, in a very strong market, we'll continue to produce positive cash flows.
And then there's a question here. Are you considering selling more ships to bring down the LTV, or is that business as usual? I mean, you have some sales once in a while.
Yeah. So we actually sold a bit this year already, and that was part of our fleet renewal program. So at the moment, we don't see ourselves as sellers. We think, I mean, there might be one or two ships, but that will not be one of the main triggers. The fleet we have now, we actually feel we should try to extend as far as we can, because we have already cleaned up the fleet earlier this year.
Okay, cool. And just to repeat, the way I see this is that you will have a minimum of 50% payout and a maximum of 80%. Is that fair?
That's correct.
Okay,
Yeah,
cool.
That's correct.
Is there any more questions about this? Because this is obviously very a change in dividend policy is very big for the company. Cool. We'll just continue. Then let's go into your Q3 and just a few high-level numbers here. Could you take us through basically, Michael?
Yeah, so I mean, as you say, I mean, I think the numbers obviously speak for themselves, right? I mean, they reflect a very, very strong quarter again, and I think if you look at the overall result, at $280 million is obviously one of the largest. I mean, not just for Hafnia actually, it's probably in the history of listed tanker companies, this is probably the second highest that we have ever seen. So it does reflect, of course, the fact that freight rates have continued to be high. Market has continued to be tightened, and I guess we can talk a little bit about how we see the market going forward afterwards, but that's really what it reflects. And it also reflects that we in Hafnia has had basically 90+% of our fleet available to the spot market. So because we haven't done any forward hedging of any material size, we have been able to really capture full value of the very high spot market.
Cool. And one thing you always remind me about is your pool and bunker income. It's actually gone up in Q3, right? But of course, because the other things are so big these days, it's insignificant. But I guess that's part of the strategy, is to build this revenue too.
It is, and obviously it follows a little bit whether markets are good or bad. But the good thing is the revenue stream from pools and bunkers will always be there, even if markets were weak. So for us, it is an important thing, and it gives us a nice extra buffer in terms of earnings when markets are not as high as we see today. But more importantly, and this is a factor which is not in the numbers, is that by managing another 100 ships for third-party owners, it brings our total fleet to 250, which basically means that the market intelligence, the information we get from having 250 ships, is to all the benefit of ourselves and our partners. So basically, it's really the scale that helps us lift the earnings because we have improved market intelligence.
Cool. Is there any more questions to the Q3? Obviously, then the number speaks for itself. So let's continue. I'd much rather go into the market as it is today, and perhaps how you see the world going forward. Let's go into that immediately, Michael, because obviously this is very important. Actually, there was one slide before I wanted to cover. Slide 16. It was the coverage. Sorry.
Yeah.
Because for me, obviously, analyzing your stock and looking at your stock and your company, these coverage rates is very important. And I just want to remind everybody, it's the coverage of 16th of November. And for Q4, you were covered by 67%. Can you talk us through that? Because let's go to 23 afterwards.
Yeah, exactly. So that coverage really just reflects the fact that the way the market works is that you conclude your voyages, a little bit ahead. So basically, we already covered 67% of this quarter because there are certain voyages that are already concluded that will commence, for instance, end of November, middle of December, etc. So it has nothing to do with us having hedged or increased our philosophy around it. It's just a reflection of the spot market is kind of from now on, and then 30 days onwards is when you commit up to voyages. So our basic coverage in general, looking 12 months ahead all the time, and has been for this year, is that we've had approximately 10% covered that runs 12 months or more, and 90% is available for the spot market.
And if we didn't just take today's rates, basically these at the bottom low is from the 17th of November. So I guess they have improved, as far as I understand, even more since then. Is that correct?
Yes, absolutely. So what we are basically seeing now is what we call the start of a winter market, but probably also at very early stages the start of further change of transportation patterns due to new sanctions coming into place for Russian oil within the next 2 months. So what we have seen just to give you an example, what we've seen over the last week to 10 days is that medium range product tankers in Europe has gone from $35,000 per day to above $50,000 per day. When we look at the same medium range MR vessels in the US, the US Gulf, the Americas, that market even last week went from $20,000 per day in the beginning of the week to $60,000 by the end of the week. So all of this reflects really, I think, what we and others that are in the same industry as us have been saying throughout the year, is that in a situation where you don't have any significant new vessels coming and you have low inventories, that just means that oil at the moment is being transported very inefficiently. And it's really a combination of these longer distances and no extra capacity coming in that in our view will keep the market up at high levels for a long time.
Cool. And then let's talk briefly about, I mean, Q4 is difficult to change these days. So it's more about how you act in 23, I think will also be very important for your results going forward. So when I look back, 10% at this point in time must be pretty low. Is that a deliberate action to take advantage of the market, or how do you see that?
It is, and you can say for us, even before coming into 2022, we didn't have more than 7, 8, 9% either. Obviously, we did not see the situation develop, with the war in Ukraine. But what we did see was that a period of at least 3 years where we expected that the low supply of new vessels would mean that even in a stable demand scenario for oil, would have the market move up quite dramatically. So we were always consistently going in, so we want to be spot predominantly for the next 2 to 3 years. So now, of course, things have accelerated because of that unfortunate situation. But our view is really the same, is that we still think that the spot market will produce better returns. But I should say, of course, at some point, where if you start seeing that you can lock in 3 years earnings, 2 years earnings at very high levels, then we will definitely look to increase that hedge. But we don't feel that we are there yet in terms of rates obtainable.
Okay, and speaking of the immediate rates as we are now, I mean, it started snowing in New York and it starts to snowing in Denmark this morning, just for your information. So are we entering into the winter market as we basically these days, or how do you see this?
It's probably a combination, but normally around Thanksgiving actually is the time where we normally see in our markets that activity starts to increase, and where you start seeing people trying to build inventories ahead of the winter. So I think it's a combination for sure, but the strength we saw lately, I think, is something that we'll probably see for a good amount of time now, because the sanctions that will come into place will have an even further strengthening effect. We all have to remember that even though that there are sanctions today on certain parts of Russian oil and particularly into Europe, the reality is that more than 50% of the previous Russian export is still going into Europe today, just on other ships, other owners that have chosen not to follow those directions. So what that really means is when these new sanctions come into place, then everything becomes illegal. So that means zero oil will travel. So it's quite a lot of increased demand that will be coming further into the market, since all of that oil that is going in now will have to come much further away from.
And let's dive into that. If there's any more questions to the current market, then put them now. Otherwise, we'll just continue to the outlook, because just going into that, Michael, for me, Hafnia is about that things have changed structurally, so that because I agree with you that we'll never import things from Russia again. It will take a considerable amount of time, at least until energy will be depending on. So and then these bans from crude in December and products in, was it February? I think it is.
Right. Yeah.
Can you just describe those two things possibly a bit more in detail, because I think they are pretty difficult to understand actually, and very important to understand.
Yeah, exactly. So basically, what you can say is that there have been sanctions from the EU on Russian oil, right? But the real issue has been that we've had a shadow fleet that has been able to trade in and out with Russian oil, both into EU but also to other places. What the difference is now we're moving into, is a complete lockdown of Russian oil. So what that means is, for instance, you will not be able to take out insurance if you're carrying any oil that originates from Russia. You will not be able to obtain any finance if you're carrying anything. And the liability and the risk lies with you as a carrier to make sure that you check where that oil is coming from. So just to give an example, the obvious choice would be that certain ships take oil out of Russia, and then you do a so-called ship-to-ship transfer. Therefore, you can say, well, it transfers to my ship. Well, I didn't load it out of Russia. I just loaded it from another ship. Those type of things are not going to be possible. So it really goes from a sanction that could be circumvented in certain ways to a complete lockdown of any oil moving into these areas.
And I believe you have a slider on this, right? I think it was number 18. Forgive me. Yes. So this has to do with the. Sorry, this is. Sorry for this. There's many slides on this, but this is just to give some comfort in that you actually are well positioned to take advantage of this situation.
Absolutely, and I think just to put some numbers on it, we think that the amount of vessels required could be anything from 80 to 100 medium range vessels just to cover that extra demand, which is quite substantial out of a fleet of maybe 1,500 overall of modern ships. So and that's on top of what we're seeing now.
Yeah, cool. And just to repeat it again, it's product tanks from February and it's crude from December.
Correct.
Yeah.
So what people can do is, as well, I think, as an investor and analyst, is to look at what happens in the crude market now, so close to these sanctions taking into place. That market has basically gone from nothing to $100,000 per day within 4 weeks, and that is partly reflecting that they are much closer to this ban than product. So it's a good place to watch what happened and then try to extrapolate that towards what can happen for products as you come closer to February the 5th.
Yeah, this was the slide I was looking for. Sorry for that.
Yeah,
cool. Let's also perhaps talk a little bit about the fleet, and because we've done these interviews for quite some time, and it basically hasn't changed. So the order situation is unchanged. Is that a fair statement?
It is, and it, yeah.
But normally you would see ship owners buying a lot of new ships in under these circumstances because the rates are so attractive, and you don't see any chance that will change.
Normally what would happen in a situation like this, if you go back throughout the last 30, 40 years, is that people would start using the cash they make to buy new ships and renew the fleet. And quite often what would happen is you order a ship today and then you get it delivered in 18 months time. So that means you can almost connect the current strong spot market to your delivery of a new ship in 18 months time. What has happened is that the shipyards have been completely filled up by other types of vessels. So container vessels, gas carriers, etc., has basically taken all the capacity away. So if we in Hafnia today wanted to, which by the way I should say we don't, but if we wanted to order a new build, a classic standard design, the earliest we would get it is sometime in 2025, and that goes for everyone. So that means basically the fleet will not grow any further from what you know today, at least into 2025.
And the slide you see here is basically saying the same thing, that there's 100 ships on order in total. Is that that is correct?
Yeah.
Yeah. Which is
so
approximately 5%.
So basically what we're looking into, and I think this is an important part as well for investors and analysts to look at, is that at any given time when our markets have been weak, it has never been because demand has gone down. Oil demand and demand for what we do has gone up over the last 35 years consistently. Every time you've had a bad market is when you have overloaded the market with new ships that are coming in. So the difference this time around is that we're going to have negative fleet growth coming into the next 2 years. There will be less ships available than there is today when you take away scrapping of older ships and new builds coming in. So we are seeing a tightening of the supply side. It will actually drop. We are seeing demand, even in a stable scenario, maintaining where it is. And then we are seeing extra demand coming from longer distances that we sail. Those are the three things that is the reason why we're all looking into a number of years where we think with a very strong market.
Yeah. So that's back to my question, Michael. Is this structural this time around? Because it seems that the demand side is there, but the supply side cannot change. So that leaves only, there's a viewer here asking for consolidation in the market, and you are basically, that's what you have been doing. What is your view on this for the time being?
On the consolidation?
Yes.
But I still think there will be more. And, even we in Hafnia will be looking at those things again. My case remains the same. It doesn't matter whether the market is extremely high or not. I think smaller entities will in general find it difficult as they move forward, particularly because we're going into a transition in an energy complex. So within the next 5 to 10 years, we all need to think about, so what will the future look like when there is less oil versus other things that we'll have to transport. So I think smaller entities, a lot of them will find it easier, and the investors will find it easier, as the deal we did last year is simply to flow in the vessels to Hafnia against payment in Hafnia shares. As an example.
As an example, cool. There's a lot of sort of more detailed questions, but I'll ask for questions on the demand supply side going forward if there's any. Otherwise, we'll just take a few things. Just a very basic one here. Is high oil price, is that a good or bad thing for Hafnia tanker business?
Well, I can say on one thing, it's bad in the sense that it reflects the bunkers that we're selling on. So the oil that we have to put into our engines will of course be more expensive. But normally that is passed through in the freight, but that's the one side of it. So the oil price in itself, whether it's high or low, is not really so relevant for us. What's more important is really where the spot price is versus the future. So for instance, if you have a situation where the spot price of oil here and now is, say, just to pick the number, close to $90, but the forward price is, much higher, say 110, 120, we would normally see that people will start to transport more oil and put it into inventory. So that normally is good because it creates more activity, and then eventually, of course, it fills up inventory. So that there is there's a back end to that. But the actual flat price in itself doesn't really have a major effect on our business.
No. Then there's a question on the low diesel inventories in the US and how that's likely to impact the market.
Well, I think in general, particularly the Western world is massively short of diesel, and particularly Europe. So what will happen is that, as if the US slows down in terms of exporting of diesel, you'll see a lot more diesel coming actually further away. So in our view, that means you'll see a lot more coming from the Far East and Southeast Asia and the Middle East. So that if anything, it'll have a stronger push for longer sailing distances with diesel oil.
Then there's a question on the Russian fleet of tankers and if there's a substitute there. I simply don't know how many tanker ships Russia has and where they will transport their oil and products to. There's a question about that, if that's a substitute and has an impact on the market.
Well, a lot of that fleet has predominantly been doing crude oil and products from, a particular crude oil from Russia to China and India. So what we have seen is really a closed market between these three nations. But the good thing has then been that obviously that crude gets refined and gets sent out to the international markets afterwards. So I think the product tanker market had benefited from Russian crude being transported further away to China and India and then turned into refined oil that has then been sailing longer again. So that fleet will continue in our view to do that, and that's what it's been doing so far. But it becomes a shadow fleet of the real market.
There's another question here, Michael, that is about cancellation of shipyard orders within bulk and also containers for the substitutions of tankers. Is that a relevant consideration?
Well, I think it's a very good question. It's a relevant question and something that we have over years seen, obviously happening between certain types. But just to be clear, I mean, there's no risk that existing VLCCs or big container ships or LNG carriers, that they will turn into product tankers for two reasons. One is that they're being built at different yard capacity docks than where you would be building product tankers. So if anything, it will be transferred to a different type of ships that's larger. And secondly, it's only really relevant to where people have options. So any other transaction that has been done, even though the vessel is only delivering in 2 years' time, there would already be a commitment for the engine, for certain things that have been bought, and therefore you can't just swap around and put in a different ship. So the real swap situation that people should watch out for is if you had a massive order book on dry bulk ships, which we don't have, but if that was the case, then normally between dry bulk and tankers, you can swap in between, but none of these two areas have any new builds on order at the moment.
Okay. Then I guess there's a financial engineering question here, and that is about your debt situation and your balance sheet. And given the interest rates at the moment, I guess the question is, if you do some payoff of your debt, you can actually go to a lower loan to value, and thereby you can pay out more. It's a tricky question because there's many ups and downs in this, but I don't know if you want to comment on this.
Yeah, but I mean, that's also, I mean, that is also, I mean, part of our plan is to do both, right? So basically what we did last year is when we took those two transactions with CTI and Scorpio, they were all 100% financed basically. So we always knew that we need to reserve capital going forward to reduce that debt and refinance it. Obviously coming into this market with that type of financing has been great because it's given us a high gearing and a very high earning base. But that's also part of what we want to do. We've already done a bit and we'll continue to make sure that we do reduce that debt. So for sure that will be part of it. It will not only be focused on the asset appreciation, it's also about reducing debt.
Cool. I'll just check for more questions here. I think there's a sort of more general question about your ownership structure as of today. You've done a few things over the past 6 months. Can you comment on your ownership structure today?
Yeah, so our largest shareholder is the BW Group, which currently is between 48-49%. And then we've managed to basically a lot of the previous investor shareholders we had and have been selling out concurrently. So we now have a good free float. The second largest is Oaktree with around 9% of shares. And then basically the rest is spread out amongst a lot of different shareholders.
Cool. I actually think we are through the questioning round, Michael. Thank you very much for attending, and thank you for all your questions. I hope you got some of the 3 of the basic questions answered here. Otherwise, I know you have another analyst meeting. There's a final question here, and that is, do you have any plans for buybacks, Michael, versus the dividend?
Not at the moment. I mean, it's part of a debate that we have all the time, but for now we have decided to focus on dividends. But that there is a plan at certain levels and certain discounts to NAV where we could consider to do share buybacks also. But in the current environment, we focus on the dividend.
Many thanks. I think this concludes today's session. Thank you very much for attending, Michael, and thank you for all the listenings. Thank you very much.